Wipe the window off.
Also mine, like the color tape, rub your elbows with the wrong motion, make it.
What's happening, everybody?
Hey.
Hey, hello.
Yeah.
Hello, everybody.
What's up, Dennis?
Oh, D.
Y'all see President Obama last night?
Yes,
Oh,
we
yeah.
did.
Yeah.
Still my president.
What a guy, man.
How come 45 can't talk like that? Yeah, Obama can talk. He can give a speech.
That's why 45 so upset he don't compare.
Yeah.
And never will.
Yeah.
I think his house of cards is crumbling all around him, man. You see Bannon.
Yeah.
Oh, yeah.
And also his taxes. They said, hey, they can get them taxes.
Yeah, New York. Yep, New York in another case. Yep.
Yep.
MSNBC just did a complete breakdown of this whole post office thing and how this all started back in 2004 from Amazon and Bezos.
Wow.
Basically, it's some petty indifferences.
Yeah.
Mm-hmm.
Didn't nobody buy any Goodyear tires, did they?
Right.
But I don't need any, so.
But like they were saying, I saw on the news last night, see, Ohio's a swing state. He needs that. And Goodyear employs 680-something people.
Yep.
You know? So he's shooting himself in the foot.
Yeah.
Like he always does.
Yeah. He got good. They said he got Goodyear tires on the Beast. So I wonder if he took them off the Beast.
For decades. For decades.
Yeah.
Yeah, for decades.
Oh my God.
And is it on the first responders, the fire trucks? And
probably. I think, probably law enforcement stuff, yeah.
Hey, Sabrina.
Hi, sorry, the video was on.
What's up? What's up?
And then not only that, Goodyear is the only American made out of the top four, correct?
Yeah, and their stock has been going down. Everybody else's stock been going up, and their stock has been going down.
Well,
here's the deal, man. I've learned that in all you're getting, you need to get information. Mm-hmm. And for him to move like that on a screenshot, and based on that screenshot, it was out of pocket because you can't have Black Lives Matter being worn and not having, the other Blue Lives Matter or whatever. So don't have none of it being worn. So it felt like it looked like it was some little policy for the one store, and maybe the manager put that out there or whatever. But to go after the whole Goodyear, it just tells me he's so knee-jerk and he's so petty, and he'll retweet or he'll mandate or he'll do whatever he can without getting all the information.
Yeah.
Right.
It's just how he moves.
Yeah.
This dude is ready, fire, aim.
Ask questions later.
Yeah,
it's gonna be interesting. It's gonna be interesting with Steve Bannon and other guys getting arrested. It's gonna be interesting.
They were saying they got a good paper trail on them.
Oh yeah. It's a shut case with them. They were stupid. Yeah, and they was spending money and stuff. And
he's done.
You see how 45 tried to distance himself from this on. I don't know if you all know the format for tonight. Delos, I think he spoke with you, Sabrina, yesterday, and him and I talked today. He's not gonna make it on, but he had like an emergency to run. And Sabrina, we're gonna go through the vertical push spreads like we talked about. I guess you can tag team with Cormisha. She's got to get off. Is it 8 o'clock, Cormisha?
Yeah.
And then whatever time we have left, I want to introduce you guys to something that I'm still working through. It's about a weekend. And I've just figured more eyes on it, more people kind of aware of it. We can all just come back and see what we think about it. But it's very, very interesting. And I'll talk more about it once we get to that phase tonight. But we can go ahead and jump in because I think this is probably it. And whoever else joins, we'll go ahead and admit them.
Okay, that's me. I was trying to share my laptop if you guys can accept that.
Oh, I don't even see it. Oh, there we go. I do see it. Okay.
Okay. I did that there. Hold on.
So we got a substitute teacher. Don't nobody act up in the room.
Yeah, no questions.
Did you see that? Did you see that apple I put on your desk?
I did that.
You didn't eat my apple yet, did you?
I did it. Hope there's no worms, right? All right, can you guys see that screen?
Yes.
Yes, ma'am.
So tonight, huh?
It's gonna be so professional.
Oh, no pressure.
Oh, she made a PowerPoint.
PowerPoint.
Brian said y'all was gonna haze me. No hazing. So let's talk vertical spreads. And you may be asking, what is a vertical spread? Well, it's one of the most basic option spreads. There are others such as straddles, strangles, condors, iron, butterflies, iron condors, but they're all pretty much built from the base of a vertical spread. There's two components in a vertical spread, or two legs, if you will. There's a long option and a short option. The requirements are that they are for the same underlying security with the same expiry date, but at different strike prices. So the long option, also known as a buy, plus the short option known as a sell, create our vertical spread. To open a vertical spread, you can do that by either creating a buy or a sell option. For the sake of tonight, we're going to focus on selling to open. That way we are creating a vertical put credit spread because we want to receive a credit. So we've been taught that we want to sell options to collect the time premium. And most of those have been through the form of a naked put. So we had a stock, for example, that was trading at $108, and we wanted to sell a 100-point put for a premium of $3. What would happen is we would be paid a $300 premium per contract. And as time moves towards expiration, as long as the stock was trading above our put price of $100 at expiration, we will get to maintain our $300 credit. The option would expire worthless and life is good. But what are the disadvantages of this naked put? It has a larger capital requirement for one. In this example, that $100 put would require about, $9,700 to open $9,700, $970, $1,000 less than $300 premium that we would collect. In addition, there's an undefined amount of risk with this option because the stock could trade anywhere down to $0. Additionally, there's a lower probability of being successful with this type of trade. So again, with the premise and the idea that we want to sell options to collect time premium, let's look at the vertical spread. So we had a stock trading. We want to look to sell a put option out of the money. At the same time, we will buy another put further out of the money. This would generate a credit at the difference between the two of these. But again, you still may be asking, why would I want to trade a vertical put spread for a credit? Again, I have a defined amount of risk in this type of trade. I have a higher probability of being successful, and there's a small capital requirement. So let's look at a couple scenarios on a vertical put. We want to look at a put where we actually sell a 100-point put and collect the $3 premium. At the same time, we're going to buy a $95 put for $1.20. Same scenario, the stock's trading. As it nears expiration, it expires above both of our strike points of 95 and 100. What happens? Well, the $100 put point expires worthless. That's what we're used to today with the naked puts. We keep our $300 that we collected in a premium as profit. The $95 put also expires worthless, but it costs us $120 to open that contract. So the net credit we will receive is $180 for that vertical. Now, may not sound sexy, but that's the maximum profit for that particular vertical spread per contract. Let's look at a different scenario. Same options that we're looking at, but the stock drops down to $70 at expiration. What happens? Well, we're $100. Our $100 put is now $30 in the money. So that's a net loss of $2,700. If you look at the $30 times 100 shares, $3,000 less the $300 that we collected, $27 loss. Doesn't sound so great. Also, the buy now is worth $25 more than what we actually purchased, the 95 to 70. So that's a $2,500 in profit, less the $120 we spent to buy it. So net $2,380 in profit. The difference between those is a loss of $320. Not exciting, I know. But this is the maximum amount that I would lose no matter where the stock ended up at expiration below my $95 buy. This is how I define my risk. If you can look at any vertical put spread at any time to figure out what your maximum risk would be by taking the difference between the strike prices, which in this example is a $100 put less than $95, subtracting the entry price, which is the difference between the premium you collect on the sale and the premium you would pay on the buy, which is $1.80, the $300 minus the $120, and that gets you to 3.2 or $320 per contract. That's the maximum loss no matter where the stock trades below your points. The last scenario is what happens if the stock lands between my two prices and my trade. So let's say in this example, the stock price was $96 at expiration. So my $100 put is now $4 in the money, meaning I have a net loss of $100, $400 less the $300 I collected. My buy again expires worthless, but I paid $120 up front. This is a $220. Again, less than the $320 is the max that we would lose. So in the end, for me, it's about considering my risk reward for vertical spreads. I like to look at what my return on my capital looks like. An example I looked at last week was Shopify. I had a weekly expiring August 21st for a $930 point with a 5.4 bid, and the stock was trading around $987.90. Looking at the vertical put, the capital requirement to enter this trade would be $440 versus the capital requirement on a naked put, $92,460. Big difference. The credit I received was $60 versus the premium for a naked put was $540. Again, the naked put looks really, really good right now. But when you look at your return on capital, this is what got me, especially when I have a smaller account that you're trading. I'm gonna earn 13.64% return versus 0.58% return on the naked put. So when you're dealing with a smaller account and you're looking at some of the more expensive options such as an Apple or Amazon or Shopify, this gives you an opportunity to play in that arena for a smaller amount of leverage up front. And you're still using the same fundamental analysis that we've been taught. You're out of the money, you're looking at the probability of being in the money, you're looking at the success, you're paying attention. So everything else remains the same. It's just that I can play with the same equity, collecting the credit with a defined risk now, but requiring less capital.
All right, can you just go all the way back over the whole thing again, Sabrina? Because you're like, woo!
I talk too fast.
Fine.
You know, I'm like a senior learner, girl.
Yeah.
It's on tape.
It's on video.
I know that's right, boy. Man.
It's on video.
I can go back.
That's right. It's being recorded, Chuck. It's on video. So
hey,
okay. We'll let Dennis define it. Go, Dennis.
What's the question?
Go back to the second scenario. I just need to I want to ask you a question on that.
Absolutely. Let's see and find my slide for you. Can you see that? Okay.
Yeah, I can see it.
Yeah.
So
let me go through all of mine. There you go.
So the second scenario is you sold a put at $3, right? So
I sold a put at a 100 point for a $3 premium, right?
Okay, and so you made a $3 premium. You paid.
I made $300 for that put, just like a naked put.
Okay, so you made $300. Now you bought a put at 95 for 120, right?
Right.
So you actually paid 120. And then you would subtract your 120 minus the 300, correct?
So that was the maximum profit I can ever make, which was $180 on this trade. Yeah, that was my net credit.
But in this scenario, it dropped all the way down to 70, right?
Yep.
So you're counting from, are you counting from where it started at and dropped down, or are you counting from your put at 100 and drop down?
Yeah. So I'm in a sale put at 100. So I'm $30 in the money on the put on the sale, right? So that's going to cost me 30 times 100 shares, $3,000 loss. That's the net loss on that.
Oh, you already the money.
But I already earned in profits $300.
Correct.
So the net loss between that leg is only $2,700. I don't lose the full $3,000 when you look at what I collected up front.
Okay.
Now on the put side, I'm in a good position because I'm $25 up per share. Because I bought it I got the right to buy it at 95, even though it's trading at 70. That's what the buy gives me. So it's 100 shares. That's $2,500 in profit that I would make on that leg of the trade. But I spent $120 up front. So that's only a net profit of $2,380 on that side.
Okay.
So taking the difference between those two, I would realize a net loss of $320. And that doesn't matter whether the stock was trading at 94.99, whether it was trading at 93.90, 0. I'm never going to lose more than $320 on this vertical put.
Okay. All right. I understand this.
Next question.
Obviously, the appeal is like you said when you ended up the presentation. You were saying for small capital, your outlay is much less, but your return on capital is where you really make your hay.
Yes.
Versus
now this is like you said, another tool in our tool belt, right? Another trading strategy. I'm not saying to give up anything that we've been taught thus far. This is just another way to leverage our capital in a different opportunity that requires less upfront. Now, obviously, on a naked put, worst thing happens, you end up getting assigned and you own the stock. Well, you don't own a stock here. So when I say loss of capital, it's truly loss of cash. So we just have to keep and bear that in mind, what our strategies are. If we're looking to own stock, if you want to trade something you want to own, then that's obviously something we would look at differently. But in this case, you don't end up owning stock, you end up losing actually the capital. That's your net loss. But again, if we're following our fundamental analysis, we're still doing the basics, we're out of the probability of being in the money, then we're looking and hedging our probability of being successfed.
So how are you doing on this? Are you doing pretty good at
Actually, I'm doing really good. I traded. I got in Google on Friday. I did a vertical put. Let me find it. I don't want to talk without looking. I'm sorry. Before I go to that, are there any more questions on any of these slides? I'd be happy to go over it. I know I talk fast. Sorry. So let's go to this slide again. I want y'all to see this. Just that, like I said, looking at the return on capital, I'm looking at trying to get more than what I can earn in a regular savings account or what the bank's gonna pay me. So anytime, and 13% was conservative. That was a conservative example. What I've been doing is anywhere from 20 to 35 to 40%.
Wow. That's cool.
So I'm excited about it.
Yeah, I'm excited for you.
So again, but I don't have to come up with tens of thousands of dollars to do that.
So Sabrina, does Brian know how to do this?
He's learning. He's learning.
Hey, Chuck.
Oh, what's up, man?
Oh, yeah. You thought I wouldn't listen, huh? That's okay. I'll be laughing all the way to the bank.
That's okay. Look at you now.
Look at you now, huh?
So Kamisha, I know you're familiar. Anything you want to add or chime in that I didn't cover here?
You did a PowerPoint presentation that was amazing overall for it. I mean,
okay.
So like there is just on the flip side though, like the whole possibility of you can still technically be assigned overall, but like even if you're assigned, that just means that you have to close out the other one so that you can sell it. But
yeah,
that's it.
So why would they assign?
You end up in the money, like on a regular naked put, like at the end, if it's like on the sell side, and the stock price is below, like I talked, let's see.
That second scenario.
Let's go through scenario 2. So yeah, so I sold at 100, but the stock is at 70. So in a regular naked put, that would be assigned to you, right? And you end up with a stock. So this could be assigned, but then you need to exercise the $95 that you did to buy on, right? But if the stock was somewhere between here, where you didn't, your buy was out of the money, then the $100 could be assigned to you, and you'd have to close it before it gets assigned. Wow. And take that loss. But again, the net maximum you're going to lose is 320 or less. You wouldn't lose the full 320 in that scenario, which is what I explained here.
Right.
I said, with the vertical put spreads also, you said, I think last week they said that we have to have a margin account.
Yes, yeah, you have to be set up for a margin. I was able to get set up as a margin. First you get approved for margin, and then you have to do the advanced trades, which is like a naked calls, spreads and stuff. So all I did was say I had over 10 years of experience. You know, increase the amount of capital and income that we had on our accounts, and it went through the same, like within minutes. It was approved.
Okay.
Show us that Google thing.
I'm sorry?
Show us that Google thing you were talking about.
Okay, so let's stop. Let me find my little spreadsheet, and I'll tell you what I did Friday. Did I open it Friday or Monday? I want to be honest. It was Friday or Monday, but I did a vertical with Google expiring this Friday on the 21st. And I went in at 1470, 1460 on a put. I collected or credit of $1.45.
Got a share.
And I did 2 per share, per contract.
We can't see
your screen. We can't see the screen.
I'm doing my spreadsheet. Hold on. Share. Uh-oh. That's not it. I have to go back.
I'd much rather look at you than that spreadsheet.
Thanks, honey. Don't get us kicked out.
Back at somebody right now.
You need to keep your head straight ahead, buddy.
Yeah, you're right.
10 and 2, boy. 10 and 2.
Right.
Uh-oh. Sorry. Hold on. I keep trying to share the wrong screen. Hi. There we go. Share this one. This is my little spreadsheet. Sorry. So this is how I keep track of what I was doing. So I went in Amazon. I did an Iron Condor, but we're not there. And I did an Iron Condor in Tesla. But this is the vertical that I did on Google.
Good. Thank you.
Dang, so you doing Iron Condors, vertical.
Just trying it out.
Puddle straddles.
You know, she doing a choke your BF and.
So on the vertical, I went into Google with the price was $14.70, $14.60 put, right? And then I got a $1.45 credit between that. So this was a $10 spread, 60 to 70 was $10. Minus the $1.45 that I was receiving in credit meant I had $8.55 per contract at risk. So that was like, you know, the difference between them. So doing 2 contracts, I collected $290, but I looked at what my risk was for the 2 was $17, $12, $60, including commissions. I added in the commissions. Because mind you, you're doing 2 trades here now, not 1. So 65 cents times 2. So I collected $290, but then when you looked at Google the other day, Google went up to, I got out of it. So this is the part where I closed it early. The stock ran away from me, kind of like on the naked puts, right? When the stock moves so far away from you. So I looked at the P&L, I was about 89% profitable. So my P&L, I usually try to get it in and out around 90 to 95%, or I can let it expire. I just chose not to wait because I wanted to take that same money and re-enter in something else. So I paid $16 per contract to get out. So my net profit for leveraging that $1,700, I made $258. So when I did that, it was a smaller one. $258 for 1712 was 15%. So that's one of my lower ones that I earned.
Yeah, 15%.
Mm-hmm.
Yeah,
Yeah.
$1,700 for it. I think it ended up being 3 days. I got out on Wednesday. So I leveraged it for 3 days. The stock went up. The P&L on it, when I was looking at it, was, you know, I was almost at 290. I was at whatever it was, minus $16 per contract. So 2 something, and I closed it out early. I could have let it expire, but you run the risk when you wait sometimes that the market can turn on you, it could go away. So I was like, why not? I took my 90% of the profit. Yeah.
Talk about Tesla yet? I joined late because I'm out bringing home the bacon. But
so no, I didn't talk about Tesla. PayPal was one I'm in too. So PayPal was going up. I called. I have to find it. I don't have it on the spreadsheet. I called
Tesla recently.
I'm sorry.
You killed on Tesla recently, then, because Tesla went up at 100 and something.
I did. So this is the iron condor I did. But what I have to say about an iron condor is, though, the closer it gets to your call side, the less the theta impacts the price. It doesn't decay as fast. So not so pleased about that.
Right.
And you have to kind of be more specific of where you think the stock's going to land to. You got to know how high you think it's going to go versus how low, you know. So I'm not an expert in that yet. So that's why I'm not trying to present anything on that. I'm just playing around with it a bit.
Don't think I'll be doing any iron condors either.
Don't say that.
You don't.
Say that, huh?
You really don't.
Yeah.
So let me stop sharing this and share my other screen. We're just gonna go through a vertical on Thinkorswim, if that makes sense for everybody.
So Carmisha, you've been doing pretty good with this also?
Yeah, but I haven't been approved in Thinkorswim yet. So, or TD Ameritrade. So I had to use another.
You still on Robinhood?
Correct. Yeah. But like I said before, like they take forever to execute them overall on Robinhood. And so there's been like, in total, I think like 12 of them that I've tried to execute that have not been executed overall for me. So
I haven't had a lot of problem on Thinkorswim, especially when there's a lot of volume. Like Tesla is busy, a lot of liquidity in the company. So definitely look at that. There's a lot of volume in the one that you're going into as well, or open interest. And they've gone through pretty much right away.
It's Robinhood's just their brokerage is a little.
Yeah.
Okay. So everybody can see my screen. So we're looking at Amazon. So this is Amazon. This is in the simulated. So apologize if some of this is out of date. So right now it said Amazon last traded like around $32.97. So I'm gonna go down and I'm looking for something around 15% chance of being in the money. I'm not really trying to get too close. My tolerance a little lower than maybe some. So if you see, I have this one that I've already entered in, right? So it's saying it's 18% now. So this is one I traded in. So we'll just redo that. 31.50, 31.40. And I just pretty much right mouse click sell and I go up to vertical. I mean, there's a couple ways you can get there, but this is how I go in. Thinkorswim defaults to like 10 contracts. So I always pay attention to that. I'm interested in just seeing what it is for one. A key indicator here though in Thinkorswim, if it's red, you know it's a sell. If it's green, it's a buy. So that's kind of a visual representation, let you know what you're doing. So we want to sell to open. I'm checking that I'm looking at the right weekly. Yep, 28th of August. I'm looking at a point spread of 31.50 and 31.45. So I already know up front this is a 5-point spread. So before I even get to the next screen, I can calculate what my max loss is going to be. So this is a 5-point spread. They're paying me 90 cents. So $5 or 5 points minus the 0.90. It's a $4.90 risk per contract. You can, and I know that I'm ending up with a credit here. So if I look at the confirm page, see, again, this is $410 is my maximum risk or loss for this particular trade. But the maximum profit is $90. So calculating my return on credit, I'll see if this qualifies for what I'm looking for, right? I'm gonna get 21.9%. I'm pretty pleased with that. I could probably do more than one contract like that. It's $400. Another key for me is looking at your capital. So if you have a $10,000 account or $20,000 account, I try to keep my individual trades between 6% or less of my total outlay. That way, if a trade goes south on me, I haven't blown up my whole account. So if I had a $10,000 account, the max I want to risk on any particular trade at 5% would be what? $500, $600 at 6%.
Right.
So if you are a little more risk averse, you know, prone to risk or taking more, you can increase that. But this is just when I'm doing this, I'm not trying to blow up my account if anyone went south on me or didn't go the way I wanted it to work out.
Like Dylan said, everybody's risk level is different. So
correct. So again, you see here, I'm selling one vertical, 28th of August, 31.50, 31.45, 90-cent credit. If I look at my break even, I would lose nothing, I would make nothing if the stock ended up at expiration at 31.49.10. Maximum profit I can make, as I said, was $90 up front. No matter where the stock goes, as long as it's trading above, I'm not going to make any more. But the maximum loss is $410 again, no matter how low it goes below. So I'll receive my credit less my commissions again, because this is 2 legs, so 65 cents times 2. And then this is the effect on my account, your buying power effect for options. So if I didn't like that one, and I felt like I wanted to get a little closer, like I wasn't excited about the 90 cents, let's see, maybe I want to go down here around 20, 28%, maybe something less than, a better than 70% chance of being successful. Let's try it. So I can try this one. Sorry. Something else I want to show you too. Again, I'll start with just one. So $1.52, that sounds pretty good. Again, I have a $5 spread, less $1.52 in credit. That's gonna be what, $3.48. So $348 is probably gonna be my maximum loss, correct? So I can make $152. Now y'all already can tell these numbers look pretty good on your return on your credit. Yep. I don't even have to do the math. Y'all know that's almost 50. Well, let's just do it.
So Sabrina, hang on one second. Let me figure out how are you getting, you said your maximum loss. How are you figuring it out? It's a 5, okay. It's a 5 spread.
So let's save this. So you take the difference between the trades, the spread, 3205 and 3200. That's a $5 spread. There's some that are $2.50. There's dollar spreads. They're $2.50. They're $5. They're $10, and probably even more. I haven't looked at those. So this one in particular is a $5 spread. They're gonna pay me $1.52. So if I take $5 less the $1.52 that I'm getting in credit, that leaves a net of $3.48. That's my maximum loss per share.
Okay, go back. I'm not understanding the $3.48. Where you get the $3.48 from?
$5 minus $1.52 is $3.48.
$5 minus
$1.52.
Oh, okay, okay.
Yeah,
I got you.
So anytime you want to figure out your loss by looking at this, you can do it. You can go through the process, but I just kind of eyeball stuff a lot now because I'm quickly going through them. But $5 less the $1.52 is a $3.48 per share loss, maximum at maximum. So
now when you do this, you are having to buy, since you're selling 100 shares, right?
Yeah, every contract is still 100 shares, just like on the puts.
All right.
No difference. It's just like a regular naked put, sorry. It's no difference. I'm just doing a sell and a buy at the same time. And then the quantities are matched because again, we're balanced. It's not there's certain things that's unbalanced, but we're not doing that. So I'm gonna confirm. So again, that's, as I was checking, the return on my capital in this case is 43.7%. It's kind of exciting to me. For $300, I'm gonna get paid $100. I mean, I'm just saying, a small account person gets excited about that.
Yeah.
You guys know how difficult it is to find a $152 premium with $300.
Yeah, right. You
can't. This doesn't exist. So again, that's kind of to me the exciting thing, and it's in a company, Amazon. We know where Amazon is going. I don't think anybody thinks Amazon is going to fall down to, whatever this number was, before. So
let me ask you a question, Sabrina. So when you come in for the strike price where you come in at.
Yep.
Let me see how close you are.
This one, when I did the analysis, and that's the next thing I wanted to show you, is I have done I already have this set, my probability of being in the money. I don't look at out of the money on here. So this one was 28% and 27%. So I'm greater than 70% chance. Yeah. The other thing I have done here, let me move this so I can see my screen. I can't see. I use Thinkorswim's analysis. I can't see up here. Hold on. The share screen thing is in the way. I can't see. Let's see if I can move it down some.
Double click and drag.
I'm trying and it's not. There it is. Okay. So I like to play with the analysis again of the trade. So I'll go and analyze and I'll add a simulated trade. What were we just looking at? Just so I can use that one. 28 at 3205 and 3200. Okay. So let's add it for Amazon on the 28. Let's look at all. Now I gotta move this over. I was at 3205 right here. Yeah. So I'm gonna analyze the sell, right? And I wanna analyze the sell vertical. Move this up.
So do you do the 3205 or 3210?
So it's 30. Oh, I said, so I can change that. Sorry. I was at 3205 and 32, right? I want to look at the same one we just looked at. So I'll change it right here. You can always do that here as well. So make sure I'm selling the 3205 and I'm buying even further away from the money at 3200. Again, not that this matters, but I like to look at the same quantity that I'm interested in checking. So same $1.52 credit, $1.52 credit, right? And when I look here, I want to look at my probability analysis. And I know Delos has shown us a different tool, I think in Fidelity. It's pretty much the same thing, right? You can see percentages of being below a certain amount. I see my slices. So I'm at 3,200 and 3,205, right? So I want to see probability of being below 3,200. Was it 32? 3205 was my, okay. Yeah. So let's look at 3,205 because that's where I don't want it to fall below. So when I look up here for August 28th, because that's the date that I picked for my expiry, I have a 31% chance, as we expected from the same probability of analysis that I saw before. And this is the percentage that it will be at these slices above 3,205. So 69.96% chance it will trade above 3,205 on the 28th, sorry. Again, if that's too close based on your risk tolerance, of course, you can always back off. And I've done that many times because I try to get 75 and above. Honestly, I don't like anything less.
Misha, are you doing vertical puts as well?
I haven't been approved in Thinkorswim.
Oh, okay. So not Thinkorswim, but are you doing them in Robinhood or no?
When they get processed, they take forever in Robinhood.
Okay.
She had like 12 of them not processed, Chuck. Keep up.
Yeah, I heard that.
Yeah, I asked the question already, Chuck.
I know, I heard it too. I just wanted to find out. Again, I needed confirmation.
So back to the PayPal example. So I did the PayPal in my live account, and I think it was only like PayPal was like I think it paid me $190. Again, I started out small. I didn't want to do anything too large. So I looked at it this morning, and the P&L showed that it was $200 and something, I think yesterday evening. So again, the maximum I can make on this was $190. But the profit margin said 200 or something. I was like, that don't make sense. I didn't get paid that much on it. So I called Delos on it, and he says sometimes based on, and I don't know how to figure this out, what it was, but whatever the market conditions or something else, the return on that was going to be greater than what I actually invested to start with. So obviously this morning when I tried to go in and execute that, the market had changed again and it wasn't worth that anymore. So I just, the only time I've ever seen that, I asked him if he'd ever seen it before. He said he's heard of it, but I'm not counting on the maximum return. I just count on keeping my credit, because I think if I start chasing the maximum, you're gonna end up losing money. So I'm just counting the credit as a guarantee, not anything on the maximum potential. Just thought I'd let y'all know that I did see that. I thought it was weird. Questions? Everybody excited about verticals? Yeah. Kamisha is.
Yeah. Good job. Good job.
Yeah, very good.
Sorry, I spoke too fast.
No problem.
I'll work on that.
I think Delos just lost her job.
No. I'm still learning with everybody, so no. But I was
you did a good job.
I was excited about verticals probably the second or third week, babe, when we got in them. I think because I started, and I was like, because again, everybody doesn't start with a large account. I was like, how can we play with some of the
thrown off by the large amount of initial
because I didn't understand the margin, getting approved to trade on margin and stuff at the time, because I kept saying it shouldn't require, you know, the thousands of dollars. There's a way I should be able to do this, but my account wasn't letting me do it. And then I found out, you know, that you had to be approved. So, but what got me interested, like I said, I like Amazon, I like Apple, you know, I like Google, you know, I like Spotify. I like all these companies that, you know, are leading the, you know, the indexes that I'm hearing about when we watch the show. But I'm like, man, you know, I don't want to put all my money in just one trade a week. I want to be able to leverage that. And I don't want it to go south if it goes wrong on me. So the verticals were appealing to me for that. And two, I don't necessarily have to own a stock. You know, granted, I will use strategies that will own stock, certain stock, but that's not my primary goal right now. Maybe later, but for now, I'm trying to grow the account, and I'm trying to grow it in a way that I can define how much I'm risking and leverage my money in a better position. So that's why I found
Delos teaches us to do our research.
Yeah, absolutely. So I still say, go back to the fundamentals. None of that has changed in this position. It's still the same analysis that he's taught us. What we're looking at, probability of being in the money, you know, what's going on with the company in terms of, you know, stock splits or earnings or, you know, anything like that could market sentiment. So that all still applies here.
Hey, Sabrina, I got a question for you.
Yes, sir.
I love your presentation, so thank you.
Thank you. I'm a visual learner.
You know what? I am too. I guess that's why I love it so much. Like say, like when you're doing your iron condor, can you close out once after you set it up and you see how it's moving, can you close out a leg on it? And
yes.
I'm not comfortable with that. I'll try and do I've been flirting with the butterfly iron.
Oh, I haven't looked at that one, but so what I did do is, in the case of Tesla was running up, as y'all saw, right? So I was so far out of the money on my put side, I rolled that over. I did a roll. I rolled it up closer, collected some more premium, because you get paid again. Right. But that reduces your overall net loss too. So when I first set it up, if my net loss was say $300, and then it ran away from me, but it didn't reach my call side, I can move my premium, I can move my put side up closer. I'm reducing my range, right? But I would collect more premium, and that premium, say I collected another $100. Now I collected, you know, $200 to start with. I collected another $100. That's $300. That $300 now reduces again my overall risk by that additional premium. So each time you do that, you can reduce it that way. So that's what I've been playing with. I did do that with Tesla. I did roll that when it started running. And
I'm gonna have to get in the remedial class. I don't know, y'all way up here. I'm like, let me come back down to earth.
No.
Keep what you doing up there, man. Keep what you doing up there.
He said the magic word, small capital.
Yay, right? Yay.
But they said small capital count too.
I was like, it gotta be another way. It gotta be another way.
Exactly.
It's gotta be a way.
Exactly.
Yeah, so absolutely. Yeah. So I did roll, you can't roll that leg. And
what I'm afraid is about what she said about being assigned. But that's what I was afraid about. So long as I close out before, like you said.
Yeah, before it expires. Yeah.
Okay.
It won't be
a question last week. Remember when I was asking about what's the price on that Friday, and then when you execute, because it was 2 different prices, remember?
Oh, yeah, I wasn't sure about that. Okay. Yeah, so you can roll it. You can close it if you want to give the money or whatever it's going to cost you. You can close it out, or you can roll it over. If you think the market's going to turn in the favor of where you're going, you can roll it over. And sometimes you can definitely get a credit when you do that.
Yeah, I think the one thing that we need to be mindful of is really just about extracting money out the market. What Sabrina, the way she started off was saying, look, this is just another club in your bag.
Yeah.
So I'm not sweating it. I like the risk reward that I can drill down on more, but we're having success doing what we're doing now. Chuck, don't sweat it. You can go back at your own time and rewind, kind of like I'm gonna do. But it's something that I want to do, but I'm not, I'm having success. So I just want to point that out. Yeah, it don't matter. This one guy said, look, if you successful and your method is successful, it don't matter if you just looking at the moon and knowing that you got a full moon and this how much money you can pull out the market. That's being success if you can consistently do it.
Right.
So it's about consistency. So take what she
And I just want everybody to understand, this is like, to me, like, one step is the naked put. This is like step 2. This is still built on that whole idea of the naked puts that we're doing.
Right.
It's just, I'm defining how much I'm going to risk, basically. But I'm still doing the same analysis you're using to be successful with your naked put. I'm still relying on that. I'm not really doing anything out of that.
I love it because it's more inclusive.
Yeah.
Or, because many times you hear people say, oh man, y'all option trading, that's the big money. Y'all over there with that big money. Well, not necessarily, because you can do all of these strategies and still be able to play.
Yeah. And this works, like I said, you don't just have to look at it Amazon. We could do, a more cost-effective, stock, and do it on the spread. Sometimes it doesn't make sense because, hey, I can, use the same amount and make more in premium. But just for, those of us who are interested in playing with some of the more expensive ones, I think it was advantageous. But I'm not trying to replace what we've been taught. I think it's great. It's great. I still use it. I'm not abandoning it. But just wanted to have the opportunity to play somewhere else.
And it's time, like Sabrina said, like, it's times when it's better for just doing the naked put if this based upon the spread ratio and everything goes wrong.
Like, you got a $10 spread and you're only getting cents. I mean, I'm not gonna risk $900 and I don't want to risk that much on one contract. So you just have to look at those numbers and understand what makes sense for you.
So Sabrina, how does it look doing a vertical put on a Boeing, something like that?
Funny you should ask. I think I have a Boeing one. Let me look before I share to be sure. Yeah, I do have one. Let me share this screen. How did I know you'd ask about Boeing? So here's Boeing. Trying to see when I opened this. Can you guys? Yeah, you can see on screen. So I opened Boeing. I did 5 contracts expiring on the 28th with a $1.50 spread. I mean, $2.50. So it was $1.50, $7.50, and $1.60. I think I got, what did I get on the trade? I have to do the difference between here. 119 and 78.78. Got 41 cents. So it was $41 per contract. And it was a $2.50 minus 41 that leveraged $2.09. So $209 per contract that was at risk. Why don't I just go here? This might be easier for you to see it since I've already done this account. Look at this. Where's Boeing? Here it is. I did this on the 19th. Was that yesterday?
Today. Oh, no, yesterday.
Yeah. So as I said, I got 41 cents per contract. It's a $2.50 spread. 250 minus the 41. I'm leveraging the 209 is at risk, right? Do the math between the two, right? So $209 per contract. I did 5 contracts. I got paid $205, not counting commission and fees. So it was 209 times 5. So that was 205 divided by 1045. So, sorry, 205, 1045. 19.6% return.
And it was the strike price was 157.
Yeah, my spread is at 157.5, 160, and I think Boeing was at 169, 170 today. Was it?
Okay.
Let me see where Boeing. Yeah, 169.
169.
So let me close this out. But when I was looking at Boeing, if you see here, that it was 20% chance of being in the money. So I was 80% better.
Mm-hmm.
But to use this put, that would have, I would have had to leverage what, 16,000.
Right now, so it's still running right now, but it would expire Friday, right?
This one I did for the 28th. This one is not for this Friday. This is a 28th. I did it for August 28th.
Oh, okay.
But the point I'm making is that if I had tried to enter this as a naked, I would need $16,000 less.
Right.
Less the $120. I need $15,800 to enter into a naked put.
Mm.
I may not have that.
Right.
So again, it's the same equity. I'm looking at the same strike price. I still believe that the stock's gonna, run in my favor. I'm just not having to come up with as much capital. Granted, I didn't collect $160 per contract, $120, I'm sorry, here, but I collected $41, but I didn't have to leverage $16.
Right. Right.
Mm-hmm.
Good questions. More questions?
Go ahead, Chuck. I know you got a question, Chuck.
I want to hear BF explain one of them to me.
Y'all stop hazing my husband.
I don't understand that, Chuck. And you asking more questions than anybody, you still don't know.
I probably got a better understanding now. All it is I got a better understanding. That's all I wanted to know. I'm going to go back and see it.
Absolutely.
Yeah. Hey, Sabrina, I got a question. Okay. Well, I guess, Keith, you're doing them live too?
No, I'm doing it. I'm like you. They didn't approve. I don't have enough trading experience.
Okay, so because you're doing them not live now, Sabrina, are they requiring that you have because when I was trying to do it on my live one, it was saying that I still needed X amount. Your margin account, are they still making you basically have that?
No, so it's all clear. Okay, yeah, it works just the way we thought in terms of the percentage, like that buying power number. Yeah, it's just like if I was doing a straight put, naked put, sorry.
Okay. Yeah, because I was like, well, it wouldn't let me do it, but because I ain't got it for real.
No, if I had to have it for real, because some of those numbers.
Right. I was like, oh.
Yeah. Yeah. There's 6 digits to the left numbers. It's like, no, don't quite have that much. Yeah. So no, I haven't had to. That's why I said I did the 10 years of experience. I made sure, that our numbers in terms of finances looked reasonable with 10 years of experience, and it got approved. They didn't do any ballot checks or audits or anything on that.
I just gotta wait a little bit. They told me I reached out to them and everything. I have to finish up the options trading class, and they'll approve me.
Okay. Yeah, I did hear about that with some accounts that you can do it through getting that class, but Thinkorswim didn't have that requirement when I did it, so it's fine. But yeah, I've done in real life. I did a vertical with obviously Google that I closed out on Wednesday. I did a vertical with NVIDIA. I got in NVIDIA at 437.5. Made $190 on 5 contracts there, but I only leveraged $1,066. PayPal, I got in for $108, but 4 contracts and only leveraged $897. Boeing, as I said, I did get in live, and I leveraged $627 for $126. And Shopify, I got in an iron condor for them, and I made $680 leveraging $1,322. So as my confidence grows, you know, I got more excited about it.
So Sabrina, you said you went through Thinkorswim to get your margin account.
I went through TD America Trade.
Okay.
But under the general, where is it?
Yeah.
Let me go in. Sports. I'm logging in, sorry. Don't save my password. Hey,
all right, see y'all later. Great job, Sabrina.
Thanks, Kamisha. You know, I was nervous.
Nah, you get through with that PowerPoint too.
Yeah.
See y'all, fam.
I want Delos to come up with a PowerPoint from now on.
Oh, now, yeah, I want a PowerPoint.
Like I said, man, Delos is fired.
So, Jeanette, in TD Ameritrade, you went under my profile, general, and I think it was under here, the elections and routing.
Margin trading, yeah.
Margin trading, and then after it's enabled, you can go and it'll show you're eligible, I think will be here under this one for the advance before you get approved. But all I did was when I was going in for the request, you can go back through all of your questions, and then this will show you what you're approved for at your level once you get advanced. Covered, put spreads, and you're looking for spreads, basically.
Okay.
And this is what comes with it, though. You don't select these individually. This just at the next level, all of these approvals come.
Okay. Thank you, ma'am.
Well, good. Thank you.
Yeah.
Welcome. Gonna stop sharing.
Well, yeah, I can take it over. Any comments, concerns, questions on that?
You did an excellent job, Sabrina.
Yeah.
Thank you. Sorry, I will slow down next time. I had rehearsed it in my head.
No, you did good.
That is good. I wanted to bring something to the group that I spent a lot of time out there researching different material, and one guy that we're all familiar with, Oliver Velez, is somebody that I've been kind of digging deep and looking at some more of his videos, more so his master training classes. If you guys get a chance, and I want to show you some of the highlights of what I've been working on for like a week. So I want to bring a group because obviously we got more eyes, we can have more experiences in a shorter period of time. But I do want to lay the groundwork. The reason why I did this was some of you all heard that I wanted to get a little bit deeper into technical analysis. And obviously I follow my mentor. You know, Delos has been ultra successful, and I'm sure he has certain things that he looked at other than what we've been doing, the RSI, the SMA. And some of you all have your own little tactics on, you know, when to get in, when to get out, what this stock is going to do based on some of your experiences with the SMA, the 20 and the 200. So all of that's there as we know it, as we've been trained. But how about digging down a little bit deeper? We've all been in a situation where you may be able to buy it back on a Thursday, and maybe you can say, well, I can grab me another $60 and have it expire the same week. Or should I? Should I get back in? And you really just kind of going on a gut because you've done your fundamental analysis and you know that it's a good stock. Or should I open up the option chain and go into next week? Jeanette, I'm gonna ask you to help me out while I'm trying to share my screen.
Just pull up your the page that you want.
So what I wanted to do was try to find out what really do these candlesticks mean? Help me out.
What are you trying to get?
I have tabs down. Oh, there we go up there. So what I did was I highlighted some of this stuff with this guy, Oliver, and for like the remaining, I don't want to share that, right? We want to close that. For the remaining
can you all see that?
10 minutes or so.
Oh.
No.
Not yet?
No.
and I've queued it up. This will just kind of whet your appetite and give you a snapshot of kind of what I've been doing. And I've been going through a lot of these charts and looking to see if what he shared with us works, and it does so far. So I'm having a much better direction on getting in stocks, kind of predicting what a stock is going to do. It's great for if you wanted to do a swing trade, a day trade. Am I here?
Can you see that?
Yeah, we can see it. Yeah.
Mm-hmm.
For like day trading, if you want to, like Delos did with the Ford or the GE, when he shared on how to day trade. So when do you get in, and then how far do you ride it up versus just kind of getting out on your gut. So I'll let him explain it better, obviously, and I'll fast forward here and there. But this will just kind of whet your appetite. It's very processable. It's very easy to understand. Let's go.
Now we're going to throw the 20-period moving average on the chart. I want you to know that the 20-period moving average is rising. I want you to note that the NASDAQ is rising. I want you to note that the NASDAQ is rising predominantly above its 20-period moving average. Now, I want you to look carefully at this 20-period moving average, traders. The chart lies to you in a way. Look how thin the 20-period moving average looks. Well, in real life, the 20-period moving average is not as thin as your platform would have you believe. You see, all moving averages are more like zones. Let me show you this. So instead of imagining this skinny blue line, I want you to imagine it like this, like a zone. It's not a skinny line, it's a zone, you see? So when you take your moving averages when you view or regard your moving averages more like zones instead of skinny lines, you begin to understand their power from a different perspective. And so now there's no violation of the 20-period moving average by the NASDAQ. For years, this is a daily, I think this is a monthly chart, by the way. For years, the NASDAQ has failed to be able to severely break its 20-period moving average. So because of the zone-like nature of the moving averages, you can't look at this as a break. You can't look at these little brief things. These are not breaks. The zone of the 20 is not broken. All right? So always look at moving averages more like zones or channels, if you will, and they will serve you better. Now, I want to give you a valuable piece of information. Last year, I did a study on all the losses of my trading organization. So I took every single trading loss over a 6-month period, and I separated those losses into several categories. 83.
Here's the next one I want to
5, 15, 60 daily charts. It doesn't, Edward, it doesn't matter what the time frame is. The time frame, you pick a time frame based on the duration of the trades you're looking for. So if you're looking to be in a trade 8 to 10 minutes, you're going to trade a 2-minute chart. If you're looking to be in trades an hour or longer, you're going to trade a 5-minute chart. If you're looking to stay in trades all day, you're going to trade like a 15-minute chart. If you're looking to trade stocks over several days, you're going to choose a 60-minute chart or a daily chart. If you're looking to play stocks on a week, a multi-week basis or a multi-month basis, you're going to use a weekly time frame. The time frame is only important in terms of what duration of trades do you want to trade on average. You understand? So that's how you choose a time frame. And then whatever time frame you choose, you apply a 20 or 200. Time frames don't exist. The market is one fluid, giant river. It doesn't have time frames. The river doesn't have slices. It doesn't have 2-minute slices in the river. The river doesn't have 5-minute slices or 15-minute or even daily slices, really. We create the slices. We create time frames. It's a trick that we use our platforms to play on the market. We slice the market's data up for our own analysis purposes. But the market doesn't have slices. The market doesn't stop at every 2 minutes and start the next 2-minute bar. Do you follow what I'm saying, guys? That's our creation. So don't think that there's some magical time frame that's more important than the other. It's your creation. Time frames don't exist. All right? 5-minute is fine. Actually, 5 minutes is even better than 2 minutes. On the buy side. Now, I want you to note on this chart how the NASDAQ moves near the 20 and then away. Moves near the 20 and then away. Moves back near the 20 and then away. Right? So there's this cycle that repeats itself over and over again during the trend. Near the 20, away from the 20. Near the 20, away from the 20. Now, another thing I want you to remember that I told you, the 20 is not a skinny line. The 20 is a zone. Don't look at it like it's a skinny line. So look at it more like it's a channel, if you will. A channel is probably a better term for it. The 20-period moving average channel. So these seeming violations of the 20 are not true violations. It's just bouncing off of the 20-period moving average zone. So if you would imagine the 20-period moving average to be more like a fence that you can lean on. You lean on the fence and the fence bounces or ricochets the stock back. We're leaning on the fence, leaning on the fence. The fence has leeway. Leaning on the fence, but not breaking the fence. You see? So that's important to understand about the concept of moving averages. Now, in addition to that, you want to make sure that you enter in the direction of the 20, but enter on strong green bars or on green bars that eliminate the high of red bars. So here's a red bar. This green eliminates the high of a red bar right there. Boom! Now, you don't wait for that green bar to finish trading. You enter as soon as it crosses the high. The instant, the nanosecond, no waiting. All right? No waiting. And you put your protection under the red. So if you're buying above red, you put your protection under the red. You got it? So here, we're buying above red. Here's the red. You're buying above red. Boom. You put your protection under the red. It's your protection always goes under the bar that's being cleared. Great. The same principle applies. You must know where you are in the cycle in that specific time. Now, let's talk about this breathing mechanism a little bit more in detail. Here, the narrow state, when your 20 and your 200 are relatively close, they don't have to be touching. But when they're relatively close, trust me, your best opportunities are going to come from this narrow state. Your stock is going to eventually explode out of that narrow state, up or down, and you will experience flow. You're going to experience extended moves out of this narrow state. That there's going to be a greater order, a greater longevity to the moves. This is not the time to play for really, really tiny little gains in and out. You want to really focus on trying to hold and maximize as much of the explosion out of the narrow state as possible. But when you start to get the wide separation, your game is starting to get close to the end, and you have to be very careful now playing the same buy game. In fact, I'm going to teach you today that once you get wide a wide exhale state. That's what I call it, a wide exhale. The narrow state is inhale, like the market's breathing, and the wide state is exhale. When you get that exhale and that wide separation between the 20 and the 200, you need to look for the possibility of playing the market now against the moving average. Now, I told you when we first started that I had traders that I studied all of their losing trades, and 83% of their losing trades was determined by one fault, but very important things here. The two igniting bar types. Now we've got to add this to our equation. We've got the chart, we've got the 20, we've got the 200, we've got the two states. So look at what we have. We've got the chart. Let's go over it again very quickly. We've got the chart with the green bars and the red bars. Time frame doesn't matter. You pick the time. We've got the two moving averages, the 20 and the 200. The 20, the 200. We've got the two states, right? Narrow, inhale, and wide, exhale. Now we need the two bars. So everything is twos. Two colors, red and green bars. Two moving averages, 20 and 200. Two states, narrow inhale, wide exhale. Two bars, elephants and tails. I'm telling you, traders, that these are the two main bars that you need. You need to have these in your toolbox. You need these two bars in your pocket. You need this as the main part of your trading arsenal. We can make a living off of two bar types, elephants and tails. Now look at them. You've got a green bull elephant going up and a red elephant crashing down, right? Two solid fat bars, okay? On the tail side, you have bottoming tail bars where the tails are at the bottom of a body. Your body can be green, your body can be red, or you can have a no color body. The body is not the important thing. It's the tail that's important. Is the tail at the bottom of the body, or are the tails at the top of the body? But trust me when I tell you, the color type is not as important as the tail itself. Now, on the left-hand side, you've got the bullish versions of the bars. Elephants will tend to lead to more green to the upside. I should do that in a different color. Green elephants will tend to lead to higher prices. Red elephants will tend to lead to lower prices. Bottoming tail bars will tend to lead to higher prices. And topping tail bars will tend to lead to lower prices. But we need to make sure that these bars that we wait for these bars must happen in the right location. Location is key. Location in your cycle is key. Location in your cycle is key.
In the top three, Mississippi, Texas, and Georgia.
Now, take a look at the 20 period. Right.
Mute, Billy, mute.
You see, during this part of the cycle,
Gina.
What?
Never mind.
How do you want to play? How do you want to play? Talk to me. How do you want to play during that part of the cycle? You want to be long, and you want to buy in. You want to play the color game, right? Green above red, right? But where? Where do you play that game? Where do you play the green above red game? Close to the 20, right? All right, so find it. Boom. Find it. Find it. Find it. All right? Now, this is not where I made the most money. I'm going to show you where I made the most money. Right here. Oh. I want you can't see the 200 because there's not enough data. Really. Imagine the 200 is there. Here's the distance between the 200 and the 20. Here's the distance between the stop and the 20. This is freaking ridiculous. Here we go again. Didn't I show you this picture before? Didn't I draw the little man up there? Here's his whole name. Didn't I draw him before? I drew him for you, right? There he is. There he is again. There he is again. That same guy. He's crying. Look at the tears. He's crying, okay? Rodney, you remember that man? Don't you ever in your life, ever again, think about entering something that is far away from your 20-period moving average. Don't you fall for that trap. Far away, collapse. Far away, collapse. This guy is here as well, and he's here as well. I don't want you to be that guy. You're this guy. Let me show you who you are. You're this guy. You see? You're this guy. You're this guy. This is fine too, not that far away. Now, what are you doing on these moves away? What are you doing on these surges away from your key 20-period moving average? Tell me, what are you doing?
Selling.
You're selling. And if you get too far up there, I need you shorted. That's right. I need you shorted. Now, what do you short? Do you remember? Do you remember the bars? Just wait for them. You remember the bars, right? Let's get those bars back up there really fast. Wait a minute. Let me get those bars back up there really fast. Just a reminder, I need you remembering this. These are the bars. Let me push this over. Shoot, wait a minute. These are the bars. Any one of the four. All right, any one of the four. Now, check this out. Look at the red bar form. Look at the red bar form, right? The red bar form. Check this out. This red bar is moving down. Let me do it with a thicker one. Down. You're like, uh-oh, uh-oh, uh-oh. Here's my elephant bar. Here's my elephant bar. I just dive right into that elephant. Boom. Why? Why would I dive into the elephant once I identified it? Because the elephant is occurring from an exhale state. Boom. I don't need to wait. I don't need to guess. I don't need to think. I don't need to hesitate. I don't need to analyze. I don't need to check the news. I don't need to check the earnings. I don't care what's going on. You give me a fat red elephant from a wide extended state, and 100% of the time I'm putting money into that.
So that just kind of whets your appetite. He goes on and he puts in every chart that we play with, whether it's BA, he plays with some of the big ones. And now understand what he's doing. He's day trading. Okay, so you want to think about how can we extract what he's doing and make it successful in what we do. And obviously, how we enter on our strike points, using the RSI, using the SMA as we know it, and then this information here. Day trades. If you got $20,000 on a Monday or something and you want to go into Ford or GE like we learned, and you can find that inhaled state and you find that green and that 20 is going up and you want to jump in because you know that you can ride that thing up until you see it exhale. Exhaled up here, and you see that red elephant take over, and that's where you get out. Maybe you've made 13 cents on Ford. 18 cents. So these things are useful and they're just resources. And like I said, he's got another 30 minutes where he just goes over every chart. And it's just really, really consistent to the point where I just been playing with charts, looking at things today. I can tell whether I get on and I see the market is green or red. I can look at a chart and say, okay, based on what I've learned, let's see. And I'll find that elephant and I'm like, wow, it's going up. It's definitely going up. So I've played around with this and I want to introduce this to you all because I think it's valuable information. And there's so many guys out there that's doing this kind of stuff. But I figured, man, if you've heard this guy's credential, and I know some of y'all know, Tony, you know, and he's been trading for 35 years and his credentials are very, very solid. He's got a gift of transferring information. Many times there's brilliant people out there, but they just can't transfer the information. So he does a great job and he blows up his rooms and he's always got technical issues because there's too many people in there. So it's like Teddy Riley, man, get your equipment right, you know? But you know it's gonna be 20,000 people in these things. And this particular one, before we got into it, he was talking about it's his birthday and he grew up where his parents made him give on his birthday. So he had to give gifts on his birthday. And this was his gift to us. He was saying, this is valuable, valuable information. You've never heard it. And happy birthday. I want to give you all a gift because this is what I grew up to do. So this is accessible, man. I can put the link up and you can finish watching it. But I wanted to give you that foundation of inhale, exhale, away from the 20 and those elephant bars, because it's something now that we can begin to look for. And we can all confirm it or see how it works and see how we can implement that.
So Gerald, is this just various separate videos or is this like a course or?
This is what he calls his master training class. So okay. he goes on and he gives out tremendous value, even though he does pitch what he does. Like we all know that he has traders and then he puts them on a course and gives the traders his money to trade. And if they trade, I think it's $3,000, he's got a chart. They start off, if their profit $3,000, then they move to the next level, et cetera, et cetera. And before you know it, he's keeping 60% of what they make and they get 40.
Right. He started them out with 50 grand once they hit that 3,000.
50 grand all the way up to like 250 grand, $250,000.
For the rest of their life.
Yeah. So he's got, and then somebody asked the question, man, with this kind of deal, do you have any AI software? In other words, you just set it and forget it. He was like, yeah, I got 12. I used to have 14, but I got 12 programs out there that just trade by themselves, basically using this concept. So, I mean, he's got a lot of fluff in here and he talks about, if you write it down, like everything we just learned going up and away from the 20 and the little man on the flagpole, he teaches you how to write it down. So it doesn't matter if it's trading underneath the 20 or the market's on top of the 20 or what. He's just all about near the 20. It's the number, it's the color game. Green overtakes red, green overtakes red. And then if you're coming down, it's vice versa. It's the color game coming down. And then if the market's in a exhaled state, that's when you're looking to get out of it when one of those elephants come. The color, the igniting bars, the two igniting bars. So just something to think about. And it's something that we can begin to look at. And I've been doing it for a week. And I'm gonna focus on his master classes because he takes his time. He gives you about 2.5 hours. And I'll just go through them, man, and just extract what I can use.
Yeah, he's good. He's good.
I think he's scheduled for the Money Show. Delos and I was talking about it. I know, Tony, you watched him once.
Yeah, he had a class. He was talking about the gap in between the 20 and 200 or 50 or something. But Yeah, he did give a class.
All right, man. That's all I got, people. Anybody got anything else? How y'all doing out there?
What's for dinner, BF?
Making shrimp poor boys and some peppers.
Oh.
You see that?
Yeah.
Show off.
Yeah.
I wouldn't say nothing. I know Chuck hungry over there.
I'm gonna go make a bowl of cereal.
I just got to make something before Missy get home because it don't matter what it is. It's 7:30.
Bacon and eggs, Chuck.
Yeah, something. It could be bacon and eggs, cream of wheat, anything but rice. I can't do no rice. Sorry.
Oh, Lord, Chuck.
Oh my gosh.
Don't do hot dogs, Chuck. Don't do hot dogs.
Back in the day, throw some bologna on and cut the edges so it lay flat.
Something.
Yeah.
Oh,
I'll poke a hole in the middle.
Y'all got
a hole in the middle.
Y'all keeping me up here because, I'm going to be running to the thing and put the skillet on the stove and turn the iron on like I've been,
Slaving.
Yeah. You know what I'm saying?
All right, guys, I'm out.
All right.
Okay. Well,
All
y'all
right.
have a good night. That's
All right,
all.
y'all. See y'all later.
Be safe. Bye-bye.
Bye.
If you watch some of my trades, you see me do this virtually every